Today I want to share with you the secret to career cruising altitude. So at your stage of the game, you're looking at this, and this is time coming out this way, and we're using dollars as a sign of career achievement because they go roughly together. And at this point, you're right here. And so what you're thinking is, I'm going to ride this thing up as high as I can. Now here's what happens in real life. You get out here, and sure enough, you're traveling along this line, and then you get to a point when the increased prestige, money, whatever it is, just becomes not worth the effort. And so at that point, what you do is you've reached cruising altitude, where you just stay for the rest of your career. Now, this point of departure varies by person, but as I told you guys, I think on the first day, I'm as high as I want to go in this organization, and I don't plan to go any higher in any other organization. And so right now, I'm already on this cruising altitude. You have to figure out for yourself where that point of departure is. But I want you to understand that not everybody has to stay on this path forever. It's perfectly fine to get off that path at some point. As long as the money, prestige, or whatever it is that you receive from your career is enough to satisfy you, make you happy, then by all means, settle out into cruising altitude. Because if you are continuing up this ladder and you're no longer getting any joy from it, your pleasure in life is going to actually go down as a result of having gone further up on the deal. By the way, the further up you go up on this deal, the more people report to you. I don't know if I've told you guys this yet, but people suck. And managing people sucks even more. This thing's giving me crap. Now we'll get to that in a minute. Any questions about cruising altitude?
I feel like your own capabilities might also establish what your cruising altitude is as well.
Yes. So two things there. Number one is your capabilities, but the second one is knowing what your capabilities are. And I've worked with people who thought they were freaking great and thought they could continue on this path, but they didn't have the ability. And so then they were constantly wondering why they were failing. So I think it's perfectly fine to, as long as you are actually aware of your abilities. Now, are there some people who underestimate their abilities? Sure. Are there more people that overestimate them? More likely. Good question. Other questions? Okay. So today we are going to start on our final unit. Now remember, when we started out, we said in corporate finance there are three questions we're trying to answer. The first that we talked about in here was capital structure, and that question is, how are we going to finance the assets that we purchase for the firm? The second question is capital budgeting, and that is figuring out what assets we should be purchasing for the firm. And the third question is the working capital management question. How are we going to manage the short-term cash flows of the firm? What is short-term in accounting and finance?
Less than a year.
Yeah, less than a year. Now, of those three questions, which one do you think is the most important? Mr. Rowland, what do you think? Rowland's.
Probably short-term financing.
Yeah, the short term. Why?
Can't make it for the short term, you're not gonna.
There is no long term. Very good. Yeah, if you don't make it through the short term, there is no long term. My wife and I are planning our retirement, and she looks at me and she looks at the plan and she says, you're going to have to start eating healthier if we're going to be able to enjoy this retirement together. There is no long term if we don't take care of the short term. Okay, so we're going to be going through, and this one, there's a collection of things that don't necessarily fit together, but they all bring us back to this idea of managing our short-term cash flows. And so the first group here is the break-even analysis and operating leverage. And the first thing that we want to mention when we talk about break-even analysis is that we have basically two kinds of expenses. We have variable costs, and variable costs go directly with the number of units that we produce. And then we have fixed costs. Fixed costs stay the same no matter how many units we produce. So let's talk about fixed costs. What kinds of things do we see there? The CEO salary. The CEO salary tends to be the same whether we sold 1.1 million units or 900,000 units. Of course, it's variable in the long term. And in fact, when I worked for the people who've been trained at General Electric, if they heard the words fixed costs on your lips, they would smack you. Because they say there's no such thing as truly a fixed cost. They would call them long-term variable costs. For example, think about a building that we're renting. We would call that a fixed cost, but how could we get out from underneath that cost going out into the future?
Not renew the lease.
Yeah, not renew the lease, right? And so they would say there are short-term variable costs and long-term variable costs. They get upset with fixed costs. So when I say fixed costs, I want you to think in the back of your head, these aren't necessarily permanently fixed costs. They are ones that could be changed. For example, you think about all of the people in the administration at this university. We've got a huge fixed cost there. But are they truly fixed? What if we decided to cut out some of that and send some of those? We called it sending people home when I was in industry. It sounds so much nicer than firing or laying off. Yeah, we're going to send Bob home. So if we sent some of those people home, we could reduce that cost. So it's truly a long-term variable cost. And then we've got variable costs. And you've got, of course, the standard ones we talk about are labor and raw materials. What else could we think about that might be some fixed cost and some variable cost?
Electric.
Oh, very good, electric. In fact, I think that deserves a coin. I don't know if I can get it that far back. Oh, sorry about that. I'm sorry, I'm my hand-eye coordination, and I throw like a girl. Yeah. I can say that in front of you guys, right? Because we don't have any girls in here to be insulted by it. Okay, so back to the story. Electricity. So in the factories where I worked, the machines that we used to produce things were powered by electricity. And so for every unit of production, we would consume a certain amount of electricity. But what else were we using electricity for?
Just the general, it's, running the lights, running the office spaces.
Yeah.
Those are going to stay on regardless of how many units
Oh,
you're
yeah.
producing.
So definitely the lights. You got to have the lights on regardless of how many units you're producing, unless you're one of those robotic dark shops, which we haven't quite gotten to yet. So you got to have the lights on. And then there's a certain amount of heating, ventilation, and air conditioning that you have to run regardless of how much you're producing. And so electricity is one of those things that goes into both fixed and variable cost. Do you think those are easy to tease out? No, you basically have to have meters on all your equipment to be able to figure that sort of thing out. Not easy to do. Okay, any questions on fixed costs or variable costs? So let's talk about break even. And the first concept that I want to throw out here is marginal contribution. The marginal contribution is, on a per unit basis, it's the price minus the variable cost. The price minus the variable cost. And hopefully your price is higher than your variable cost. If it's not, you've got a negative marginal contribution. You should not be in business. But we can have a price that's higher than the marginal cost, but is still not enough to cover the fixed costs. So what we see is, in the beginning, that marginal contribution per unit goes totally toward paying for your fixed costs. And then once you hit the point where you have paid off all your fixed costs, then that marginal contribution becomes nothing but pre-tax profit. And so that's how this works. That point at which you have covered all your fixed costs is called the break-even point. We have broken even. So this is kind of like, you can think of, we talked about break-even and payback. What's the same idea here? It's only instead of the number of years, it's the number of units. How many units must I produce to cover all my fixed costs? Because after I've covered those fixed costs, I have broken even, and now I'm starting to make a profit. Any questions so far? So far it sounds really easy, but it turns out, we'll talk about something simple here, and then we'll get into how it's a little more complex than that. So here's a very simple break-even example. Our fixed costs are $8,000. Our variable costs are $2 per unit. Each unit sells for $4. What level of production will result in zero profit? So what is zero profit? Well, that's when the sales revenues are exactly equal to our total costs. And so we can actually put together a formula here for our sales revenue. It's just the price times the quantity, and our total variable costs, or our unit variable costs times the quantity of sales plus our fixed costs. And so our sales revenue is just going to be 4 times Q, which is our quantity. Why 4? Because these things are selling for $4 a piece. And then we have the fixed costs plus 2 times the quantity. Why 2? Because that's our variable cost per unit. And so I can basically then just solve that thing for Q and figure out that our break-even point is at a sales of 4,000 units. Can anybody tell me what the marginal contribution per unit is in this example?
$2.
Yeah, $2. And so if we took that 8,000 fixed cost and divided by the $2, we would once again get 4,000 units to be our break-even point. Questions? So now let's talk about the 3 types of break-even. Profit is kind of a loose word. People use it in different ways. If you talk to accountants, what is their measurement of profit?
Net income.
Net income, thank you. And so for accounting break-even, it would be the point at which the net income is exactly equal to 0. That would be accounting break-even. Now in finance, we understand that net income isn't really cash. And so we talk about the cash break-even point. And that's where the operating cash flow is exactly equal to 0. And then finally we have the financial break-even, and that is the sales level at which the NPV is exactly equal to 0. This thing is not going to be a positive NPV project until our quantity exceeds that level. So as far as being able to work them out with a formula during an exam, we will only be talking about the first 2. We'll talk about accounting break-even and cash break-even. If you want to do financial break-even, you need to build an Excel spreadsheet like we did for the Baldwin example. And then you can crank your sales levels up and down until you hit a 0 NPV. By the way, you could use Solver, right? You could set the production level equal to whatever based on NPV equals 0. So you could use the solver. Well, let's go ahead and take a look at accounting break-even. So what are the variables that we use here? Well, we have big P, which is the selling price per unit. Then we have little v, which is the variable cost per unit. And of course, P minus V is our contribution margin. Q is the total units sold. And so our sales, S, is just going to be equal to big P times Q. And then our variable cost, VC, is going to be equal to little v times Q. Our fixed cost, FC, our depreciation is D, and the tax rate is T. So we said that this break even is going to happen when net income is equal to 0. So what we need to do is come up with a formula here for net income and then set it equal to 0. So we're going to take sales minus our variable costs minus our fixed costs minus our depreciation and then multiply that by 1 minus the tax rate. Multiplying by 1 minus the tax rate basically handles us having to pay taxes. That's what that does. And we're going to set that equal to 0. Well, something really fun happens when I set it equal to 0. If I divide both sides by 1 minus t, what do I get? What happens to the 1 minus t? Yeah, it just goes away. And so for accounting break-even, the tax rate is not important. For accounting break-even, the tax rate is not important. And so what can we do now? We can rearrange what's left. And how we're trying to rearrange this thing is to get everything that's going to have Q in it on one side and have everything that doesn't have Q in it on the other side. So what are the things up here that are going to have Q in it? Well, we've got our total sales, which is P times Q. We're going to have our total variable costs, which is little v times Q. And so we're going to put our sales and variable costs on one side. And then we are going to put our fixed costs and depreciation on the other side. How do I get them to the other side? Well, I have to add them to both sides. And when I do that, I end up with S minus VC is equal to FC plus D. So now we can go back and substitute in for sales and for total variable costs. We can put in P times Q for sales. We can put in little v times Q for variable cost. And now we have that line where we can solve for Q. So I jumped straight to Q. Well, what did I do in the meantime? Well, I don't know what the word is. I undistributed Q. So I've got over here on the left-hand side, I would have Q times P minus V. Do you guys see how that works? It's the opposite of the distribution. And that's equal to fixed cost plus depreciation. And then I can divide both sides by P minus V. And that leaves me with Q is equal to fixed cost plus depreciation divided by P minus V. What's another word for P minus V?
Your marginal cost.
Yeah, it's the marginal contribution. And so what we're really looking at here is fixed cost plus depreciation divided by the marginal contribution. And when we solve for Q, that's going to give us the accounting break-even. Any questions about accounting break-even? By the way, do you think the accounting break-even formula should be on your note sheet? Yeah, and it would be that Q is equal to FC plus D divided by the marginal contribution. Now let's talk about the cash break-even derivation. So when we say cash break-even, we're talking about the level of sales that's going to make OCF equal to 0. And why is this different than net income? Well, there are non-cash things in net income. So non-cash things, the big one that we talk about is depreciation. But if you've got other non-cash expenses, those need to be added back to get to OCF. So we're going to do one more thing here. we are going to ignore taxes when doing OCF break even. We're going to ignore taxes when doing OCF break even. Now, we could include taxes, and I have done it before, and I have derived that equation, and if you're interested in it, let me know and I'll send it to you. But for ease of use here, we are going to ignore taxes. So what is our operating cash flow? Well, it's going to be our sales minus our total variable cost minus our fixed cost minus depreciation plus depreciation. Why am I adding back depreciation?
It's not a real.
Yeah, it's non-cash expense, right? So I'm going to add it back to get to my operating cash flow. Now, in theory, there should be a minus T in here, but we say we're ignoring taxes. And so we have just simplified this down to S minus VC minus fixed costs. Now, once again, we're going to put all the things that have Q in them on one side. That would be the sales and the variable costs. And the other stuff is all going to be on the other side. So once we do that, we've got S minus VC is equal to our fixed costs. Then we will substitute in P times Q for sales and little v times Q for variable costs. And then we can solve for Q. Once again, I'm going to be pulling that Q out, and then what's left beside it is P minus V. I'm going to divide both sides by P minus V, and therefore I get the formula that the break-even point, OCF break-even, is the quantity divided by, is the fixed cost divided by the marginal contribution. It's just the fixed cost divided by the marginal contribution. What's the only difference between this and the accounting break-even formula? Feel free to look back one slide if you missed it. Yeah, there's no D in here. So any firm that has depreciation, their accounting break-even will always be higher than their cash break-even. Let me say that again. Any firm that has depreciation, their accounting break-even will always be higher than their cash break-even. Any firm with depreciation, their accounting break-even will always be higher than their cash break-even. The accounting break-even will never be lower than the cash break-even. Questions? Okay, so let's do an example here. We've got a new product. It's going to require an initial investment of $5 million, depreciated straight line to zero over 5 years. How much is the annual depreciation? Yeah, 1 million. This math is not hard. Our price is $25,000 per unit, and our variable cost is $15,000 per unit. How much is our marginal contribution per unit? 10,000. Additionally, our fixed cost is $1 million per year. Sometimes people get confused and think depreciation is part of the fixed cost. It is not. Depreciation is not part of the fixed cost. Okay, so what is our accounting break-even here? Well, we know we've got to take our fixed cost plus our depreciation and add them together. 1 million plus 1 million gives us 2 million. And then we need to divide by that marginal contribution of 10,000, and that gives us 200 units. What does that mean? If I only produce 199 units, my net income is going to be negative. If I produce 201, my net income is going to be positive. If I produce exactly 200, my net income will be zero. Now, what about our cash break-even? Well, remember we said the only difference between the accounting break-even and the cash break-even was the lack of depreciation. So for the second one, all we have to do is have that $1 million in fixed costs and divide by our marginal contribution per unit of 10,000, And that allows us to figure out that our cash break even, ignoring taxes, is 100 units. Now, let's think this through logically. If I throw taxes in here and I include them in my break even, where do you think that's going to fall? Is it going to be lower than 100? Or is it going to be higher than 100?
It'll be higher.
Yeah, it's got to be higher. Remember, taxes are a real cash flow, so any additional cash flow, we would have more cash going out, and that means we'd have to sell more items at $10,000 a piece, or at marginal contribution at $10,000 a piece to cover those taxes. Does that make sense? Okay, questions? So let's talk about operating leverage. And I think we talked a little bit about operating leverage in chapter 12. Operating leverage is the relationship between the change in profit versus the change in sales. And so if you've got an operating leverage of 1, it means that if your sales go up 10%, that your profit's going to go up 10%. And we said, and I didn't prove it to you at the time, but we said that if you had no fixed costs whatsoever, your operating leverage would be exactly equal to 1. But the more fixed costs you have, the higher your operating leverage is. How does fixed cost impact this? Well, we say that the degree of operating leverage is equal to 1 plus the fixed cost divided by the OCF. So that's our formula for degree of operating leverage. Now, the degree of operating leverage actually depends on the sales level that you're starting at. And here's the reason why. Do you think your operating cash flow depends on the sales level that you are at? Higher sales, higher operating cash flow. And so as a result, we will see that the degree of operating leverage actually changes as we move up. And so your fixed costs in the beginning, when your operating cash flows are low, your fixed costs are large compared to your operating cash flow. And so your degree of operating leverage is quite high. But when I start producing 1 million of these things, that operating cash flow is then going to be quite high compared to the fixed costs. And that thing is going to get closer and closer and closer to 1, but it will never actually identically reach 1 because your fixed costs are always going to be positive, and so this thing is always going to be somewhat greater than 1. Most of the time, though, you're going to see that it's somewhat greater than that because of the relationship between fixed costs and operating cash flow. So let's do an example. So we're going to use the math from the previous example. We've got sales of 300 units. What was the break even for accounting break even for this? 200 units. And what was the cash break even? 100. So we know that we are, it meets both of our break even measures. So the question is, what is the degree of operating leverage at this sales level? Well, remember, it has to be fixed cost divided by operating cash flow as part of that formula. So we have to figure out the operating cash flow. And how are we going to do that? Well, we're going to take that marginal contribution times the 300 units minus our $1 million. Where did that $1 million come from? We sell $1 million for depreciation. Is that depreciation? No, we said for operating cash flow, we're going to subtract depreciation and then add it back.
Yeah, it's our fixed cost.
Yeah, it's your fixed cost. And so what we're basically looking at here is contribution margin times the quantity minus the fixed cost is going to give us our operating cash flow at 300 units. And that operating cash flow at 300 units is 2 million. We throw that into our formula for degree of operating leverage. Fixed cost of 1 million divided by the operating cash flow at 300 units of 2 million. When I do that math, I get 0.5 and I add it to 1, gives me 1.5. Well, what does that mean? It means that if we have say a 20% increase in our sales, we could expect our operating cash flow to go up by 30%. Why? 20% times 1.5, the degree of operating leverage, gives us that 30% change in our operating cash flow. We can do this with other measures of profit too, right? But we're just going to do it with operating cash flow here. So what would your new level of operating cash flow be? Well, it would actually be $2.6 million because that's 2 million times 130%. Now we could actually throw that back into the formula and figure out what is our new level, new degree of operating leverage at that point. It would be 1 divided by 2.6 plus 1. It's going to be something less than 1.5. Do you guys see that? It's going to be less than 1.4 even. Any questions? Okay, so that's the end of break even and operating leverage. Okay, next we're going to talk about tracing cash. We're looking at sources and uses of cash, and we're going to be talking about 2 different cycles, the operating cycle and the cash cycle. So what's our goal? We're going to discuss the short-term operating activities of the firm and take a look at their impact on not only cash, but also on net working capital. For instance, if I sell twice as much stuff, what would I expect to happen to my net working capital? I'm expecting it to like roughly double, right? And so we know we're going to have an impact on net working capital. And by the way, net working capital, we're still talking about this all the things within a year, right? And so this is why this is part of question 3. Okay, current assets expected to turn into cash, produce cash within the next year, and current liabilities are expected to require or consume cash within the next year. Just as a practical matter, which is more likely to happen? A current asset turning into cash or a current liability requiring cash? Let's talk about what's in current assets. Throw something out here. What's in current assets?
Accounts receivable.
Accounts receivable. What has to happen with accounts receivable before it turns into cash?
You have to get paid.
You have to collect it, right? And do people always pay their bills? No. And so we see that there's a less than 100% chance that those accounts receivable are going to turn into cash. What else is in net working capital? Inventory. Are we guaranteed to sell all of our inventory within the year? No. And even if we do sell our inventory, what do we get instead of cash? Accounts receivable. And are we 100% sure we're going to collect? No. And so what we can see is that the current assets are far less likely to turn into cash than the current liabilities are to consume cash. What kinds of things are in current liabilities?
Accounts payable.
Accounts payable. Do our vendors expect for us to pay them? Yeah. What happens if we don't pay our vendors?
They stop supplying,
Yeah, they cut us off. What does that do to our business?
shuts it down.
Boom, right? And so we're going to pay our bills. We also have the current portion of long-term debt. If we've got coupons that have to be paid, we got to pay those. If we don't pay them, we could get forced into bankruptcy. And so what I'm telling you is the current liabilities are basically 100% requiring cash, but the current assets are not 100% producing cash. So we have to be careful. Just because we have positive net working capital does not mean that we're going to survive the year. Questions? Okay, let's talk about cash and the balance sheet. So first of all, cash is a current asset. And so we've got our net working capital is our current assets minus current liabilities. And we could actually further break down our current assets into cash and other current assets like accounts payable or accounts receivable and inventory. And so we could actually modify our balance sheet equation. We could say net working capital plus the fixed assets is equal to long-term debt plus equity. Now, how did I manage to do that? Remember that net working capital is equal to current assets minus current liabilities. And so I could have my balance sheet equation up here as current assets plus net fixed assets, or we'll just call them fixed assets, and we could say that that was equal to current liability plus the long-term debt plus equity. Does that look realistic? Have I made any mistakes here? Okay, what happens if I subtract current liabilities from both sides? I get current assets minus current liabilities plus fixed assets is equal to the long-term debt plus equity. What can I do with this right here? What can I replace it with? Yeah, net working capital. And so now what I've got is net working capital plus the fixed assets are equal to the long-term debt plus equity. And so we said that we could break down net working capital into cash and other current assets. And then we can, when we plug that in, now we can solve that whole darn thing for cash. And when we do, we see that cash is equal to long-term debt plus equity plus current liabilities minus other current assets minus the fixed assets. Now, why does this matter? This equation tells us what raises our levels of cash and what lowers our levels of cash. If I increase long-term debt using this equation, what happens to cash?
Increases.
Yeah, it increases it. What if I pay off some debt? What is that going to do to my long-term debt?
It's going to decrease.
It's going to decrease it, and what does it also do to my cash?
Also decrease.
Yeah, it makes sense. You guys know intrinsically that if you pay off debt, it's going to lower your cash. What about if I go out and issue new shares? What does that do to my equity? It's going to push it up, and what does that do to my cash? That's also going to push it up. What about current liabilities? What if I go out and borrow, and we're basically borrowing money on a short term when we purchase on credit, right? So when I do that, it's going to increase my current liabilities, and when I increase my current liabilities, it's going to push up my cash. Now, what if I pay a supplier? That's going to reduce my accounts payable, but it also reduces my current liabilities, it reduces my cash. Does that make sense? Okay, now we finally get into the minus signs. So these things are going to have the opposite relationship. If I increase my other current assets, what does that do to my cash?
Decreases it.
Yeah, it decreases it. For example, I'm going to go out there and add some stuff to my inventory. That's going to push up my other current assets, but by spending that money to put stuff in inventory, it's going to push down my cash. What if I go out and buy a brand new machine? What does that do to my fixed assets? Yeah, it's going to increase your fixed assets, but what does it do to your cash?
Decreases
Yeah,
cash.
it decreases your cash. And so we can actually look at this equation, which, by the way, should you have this on your note sheet? Yeah, because it tells you how these things move together. It tells us basically sources and uses of cash. We can actually talk about what are the different things that we see as sources here. If you increase any of your liabilities or your equity, that's going to be a source of cash. If you decrease any of those liabilities or equity, you are going to be reducing cash. By the way, repurchasing, we didn't talk about reducing your equity, but if you repurchase stock, does that reduce your equity? Yeah. And so that's going to reduce your cash. What's another way we might reduce our equity? What if we paid a dividend? Right? We could pay a dividend. Would that also reduce our cash? Absolutely, it does. Then we look at our assets. Anytime you decrease an asset, that's a source of cash, and anytime you increase an asset, that is a use of cash, other than cash itself, of course. Questions? By the way, let's talk about the current ratio. Hopefully you guys remember the current ratio is current assets over current liabilities. Let's say that you figure out that your current ratio, by the way, for a healthy company, current ratio is going to be greater than what?
Greater than one.
Yeah, it's got to be greater than 1, because if it's less than 1, it means our current assets are less than our current liabilities. It means our net working capital is negative. It means we will not have enough money to make it through the year. Let's talk about some financial solutions to this problem of a current ratio less than 1. What if I went out and raised some short-term money? Short-term meaning less than 1 year. And I put that money in the checking account. What would happen? Let's say it's $1 million. What would happen to my current assets?
Go up by $1 million.
I go up by $1 million. So far, so good. What happens, though, to the current liabilities? Also goes up by $1 million. So have we really helped ourselves? No. How can I fix this problem? I can either borrow money on the long-term debt, and take that money and put it into the checking account. Or what's the other thing I could do? How else can we raise money? What do we say were the sources of?
Issue more equity.
Yeah, issue more stock, right? And some of you will find yourselves, hopefully you don't, but some of you might find yourselves in a position where you have to go out and issue stock to be able to get your current ratio back above 1. By the way, does a current ratio above 1 guarantee that you'll survive the year? No. Remember, your current liabilities are an almost certainty that you're going to have to pay them, but your current assets are not certain that you'll be able to collect them within the coming year. Questions? So now we're going to talk about the operating cycle and the cash cycle. So we define the operating cycle as the number of days between the acquisition of inventory and the collection of cash for the sale of that inventory. So typically, when we go out and buy inventory, are we paying cash for it?
Some of it's probably bought with credit.
Yeah, in fact, the overwhelming majority of business in the U.S. is done on credit. And so they'll ship the thing to you and they'll give you 30, 60, or 90 days to pay, something like that. 30 is the most common. And so we will be getting this inventory, but we won't have to pay for it for a while. We're going to collect the cash for the sale of that inventory. Are we going to get that cash on the day we sell the inventory? No, when are we going to get it?
We collect it.
Yeah, when we collect the receivable. So once again, we're talking 30, 60, 90 days, whatever the terms we're giving to our customers. Now let's talk about the cash cycle. The cash cycle is the number of days between paying for the inventory and collecting cash for the sale of that inventory. And so both of these cycles end at the same time, but they begin at different points unless we paid cash for the inventory. If we paid cash for the inventory, these things are exactly the same. Otherwise, the operating cycle is always going to be longer than the cash cycle. Questions? Okay, so for those of you who are into pictures, we have the operating cycle on the top. And that's where we purchase the inventory. And so then we sell the inventory, and then we have to receive the payment back. And so that's your accounts receivable period. And so I can get my operating cycle by taking my number of days that these things are in inventory and then adding to that the accounts receivable period. I add those two things together and that gives me my operating cycle. But what about the cash cycle? Well, I have to think about when is the money, when do I pay the money for that inventory? And it turns out that if I subtract the accounts payable period from the operating cycle, then that gives me the cash cycle. Do you think it's possible that we would have a negative cash cycle? I'll give you an example. When I worked in the Gulf Coast, when we were making stuff to go offshore, our terms were simple: cash. And so we would buy material from our vendors and we would get 30 days to pay. It would take us about 2 days to turn these things into products that were then going to be shipped offshore. It didn't leave the shop until they paid for it. And so we had 28 days between when we received cash for the sale of the goods and when we had to pay for the raw material. We had a negative cash cycle. That's a beautiful thing if you can do it. Think about Amazon. When Amazon sells you something, when do they get paid?
Right away.
Yeah, right away, right? But the stuff that they've got on their shelves that is sold by Amazon, what kind of payment terms do you think they're getting? Do you think they're paying their vendors right away? No, they're probably getting 30, 60, 90 days. And in fact, the bigger the company is, the longer the terms are that they force on their suppliers. Why do you think that is?
Leverage.
Yeah, they've got market power, right? So I'll give you an example here. When I worked at Walmart corporate headquarters, I was in the refrigeration department, and we were paying these people for doing work on the coolers and freezers at the different Walmart and Sam's Clubs. And they were trying to hold us to 30 days terms. And so when we got a bill that said 30 days, when do you think we paid it?
Third day.
No, man. We would just ignore it. And then we would ignore it. And then on the 60th day, we would get another bill. And that bill would include penalty and interest for being late. And so I'm just a temporary worker there and an engineer guy on his winter break. And so I raise my hand and the guy comes over, the boss comes over, and I said, this is 60 days. And he says, yeah. And I says, should I pay it? And he said, yeah. I said, I'll also pay the penalty. He said, hell no. And I said, why not? He said, 'cause fuck 'em, we're Walmart. What was he saying?
Not gonna do anything about it?
Yeah, we're the world's biggest consumer. Sorry for the harsh language. We're the world's biggest consumer of this particular service. Do you think they're going to tell us to go piss up a rope? No. FedEx did something amazing a while back. What did they tell Amazon to do?
Ship their own stuff.
Yeah, they said, we're not dealing with you anymore. You're too big of a pain in the ass. And so they strategically chose to work with these smaller suppliers. Why do you think they would choose to work with smaller customers? Why do you think they would choose to work with smaller customers? Yeah, smaller customers have less market power and they're going to treat you better. Does that make sense? Okay. By the way, do you think stuff rolls downhill as far as supplier market power? Yeah. So I was working for this little company that supplied the color that went into the liquid Tide jugs. You guys know about Tide laundry detergent? That orange is only made at one place in the world. It's in Ohio, and we were the only people who could ever make it right. And so then we were the sole supplier for that color to a company called Plastipack. And Plastipack was the sole supplier of plastic jugs to Procter & Gamble for that product. And Procter & Gamble, of course, was the sole supplier to Walmart. Now, Walmart, Procter & Gamble's big, but do you think Walmart is important to Procter & Gamble? Absolutely. In fact, if you go to Fayetteville, Arkansas, Procter & Gamble has a freaking building there. Actually, it may be in Bentonville. They have a building there that's fully staffed with people. Why? Because that's where Walmart's at, right? And so, what do you think happens? Walmart, by the way, Walmart's always pushing to reduce their cost, right? So what are they doing? They lean on Procter & Gamble to lengthen their payment terms. So Procter & Gamble is now asking for 60 days instead of 30 days. What do you think that means to Procter & Gamble? What are they going to turn around and do to Plastipack? Same thing. Now, Plastipack's going to turn around to my little company, and what are they going to do? Same thing. Now, here's where it gets interesting. You remember I said my little company? What's our market power in this whole thing?
The most.
Actually, it's very small, right? Because we're going to turn around to our plastic suppliers we are like 0.1% of their business. And we're going to say, hey guys, we need to lengthen out the terms to 60 days. What are they going to do? Right? And so eventually this has to stop somewhere, and unfortunately it stops with the little guy. Okay, so how are we going to figure out this cash cycle? Well, the first thing we're going to do is calculate the operating cycle, and then we're going to subtract the accounts payable period. Questions? Do you think it would be good to have this drawing on your note sheet? Kind of helps you to visualize the whole thing. So how do we calculate these things? We're going to see there are actually two ways we can get to this. Internally, if we are looking at our own firm, we will have the data as far as what's shown in this table here. And that is, we'll know that we acquire the inventory on day 0, we pay for it on day 30, and we sell our inventory on credit on day 60, and then on day 105 we collect on the sale. And so we can walk through all this and see that our operating cycle would be the full 105 days. But if I subtract that accounts payable period of 30 days, it means my cash cycle is only 75 days. Now, if you're looking at someone else's financial statements, do they have this kind of level of detail in them? No. So we're going to have to find another way to figure this out for other companies. And it turns out we can use the information from our income statement and from our balance sheet to figure these things out. We can figure out our inventory period. How can we use the balance sheet and the income statement to figure out our inventory period? Well, the first thing we would do is we would calculate our inventory turns. Inventory turns, we're going to see our cost of goods sold divided by inventory. Where's cost of goods sold coming from? Which statement? Yeah, it's coming from the income statement. And where is inventory at?
Balance sheet.
Balance sheet. And so then what we're going to do to get our days in inventory, we're going to take turns. Actually, we're going to take 365 and divide by turns. And so in actuality, what we've got here is 365 times our inventory divided by cost of goods sold. Do you see when I divide by turns, I'm basically just inverting that? And so that's how we figure out our days in inventory. So I can look at any publicly traded company out there, and I'll be able to find their inventory, and I'll be able to find their cost of goods sold, and I can calculate their days in inventory. Can I calculate their receivable period? Sure I can. I can take, so we look at AR turns. Oh, by the way, here our measure of sales is cost of goods sold. When we're calculating inventory turns, why do we use cost of goods sold instead of sales?
Because that's your actual cost of inventory.
It's actually, yeah, and so the key word there is the inventory is recorded at that cost. And so that's why this is an apples to apples comparison here. If it's in our inventory at $10 and we sell it, then we're going to have it in our cost of goods sold at $10, apples to apples. Now, when we're looking at AR turns, it's similar, but we are using sales divided by accounts receivable. And by the way, technically it's credit sales divided by accounts receivable, but we're assuming, unless we're told otherwise, that all of our sales are on credit. So, why are we using sales here instead of cost of goods sold? Mr. Bua?
Apples to apples.
Yeah, once again, it's apples to apples. So let's say that my sales price is $12. It's going to show up here in sales at 12, and then it's also going to be in my accounts receivable at 12. And so I can have my days in AR here is going to be 365 divided by AR turns. And that is equal to 365 times accounts receivable divided by sales. Where would I find accounts receivable on the financial statements?
Balance sheet.
Balance sheet. Where would I find sales? The income statement. So once again, we can look at anybody out there and figure out their days in AR. Therefore, I can figure out days in inventory plus days in AR. I can figure out any company out there. I can figure out their operating cycle. And then we will need to figure out, to do the cash cycle, we'll need to figure out what the accounts payable period is. How do you think you'd figure out the AAP period? Oh, we'll get to that in a minute. But it's a very similar idea to the AR period. Okay, so let's go ahead and do this example. We've got cost of goods sold here of $8,200, inventory, and our inventory of $2,500. By the way, the inventory is the average. If I give you an inventory number, just plug it straight in. But if I give you a starting inventory and an ending inventory, you just add those together and divide by 2. And so that bottom should be the average inventory. And in our case, the average inventory is 2,500, gives us inventory turns of 3.28. And so our days sales would be 365 divided by 3.28, which is 111.3 days. By the way, 3.28 inventory turns, is that good? Which is better, 12 or 3.28?
3.28.
Really?
I would assume that means you're selling more inventory.
No, higher inventory turns. If your cost of goods sold is bigger compared to your inventory, your turns are higher. So you want your inventory turns to be higher. Now, we still can't say though whether this is good or bad. And the reason is because these things vary by industry. So for example, think about Home Depot. The turns at Home Depot, I'll bet they're maybe in the 50s. They probably expect stuff to last less than a week on the shelf. When I worked in nuclear power, we would have stuff on the shelf for years at a time. Why do you think that would be okay for us, but not for Home Depot?
They're huge, they're very expensive items, so when you do make that sale, it's worth the shelf time.
Well, I think it comes down to this. When the unit was up and running, we were making $1 million a day. And this is 1991 dollars. We were making $1 million a day. So that means when the unit was down, in essence, it costs us $1 million a day. Now, I might have had a $30,000 part on the shelf for 12 years. My inventory turns would be 1/12, right? It would be terrible. But you know what? When I need that part, I need it now. Because when the unit's down, it costs us $1 million a day. I remember we had one part, and by the way, it's usually the suppliers are holding those parts for us. I remember one time the unit went down and there was a part that we needed out of a warehouse in Connecticut. We paid $40,000, and that's 1991 money, just to put that part on a private airplane, on a private jet, and have it flown from the airport nearest that warehouse in Connecticut to Russellville, Arkansas, to install it on the unit. Now, do you think they would have ever paid to put $40,000 to put me on a private jet? No way. Man, they barely pay me mileage, right? Why? Why are they willing to pay so much to get that part? Because when the unit's down, it costs $1 million a day. That's why I'm telling you the industry is important. So always be careful when someone asks you a question about, is this good or bad? Well, it depends. What's the typical for the industry? If the typical for this industry is 2 turns per year, 3.28 is great. If the industry average for this industry is 12, then this sucks. Does that make sense? Okay, the accounts receivable period. We're using our credit sales, which we said we're going to assume all sales are in credit, divided by the accounts receivable. Our credit sales in this example is 11,500. Our accounts receivable is 1,800. And once again, it's average because the accounts receivable at the beginning and end of the year probably going to be different. But if I only give you one number, just plug it in and use it. And so we get 6.39. 365 divided by 6.39 tells us 57.1 days. A couple of things here. Number one, why 365? It's the number of days in a year. By the way, when I ask students, my MBA students, how many weeks are in a year, the most common answer I get, 54. We really need to start drug testing people before we let them into the MBA program. Okay, so you're exactly right, 365 days in the year. Now, this days sales and receivable has another name. You're going to want to write this one down. It's also called the average collection period. It's also called the average collection period. And we abbreviate average collection period as ACP. ACP. And so you may see a problem refer to the day sales and receivables. You may see it refer to the average collection period. You may see it refer to ACP. They are all identically the same thing. They are all the same thing. Okay, so now that we have both the inventory period and the AR period, we can add those things together and come up with an operating cycle of 168.4 days. So how do we interpret that? It's going to be 168.4 days between the time we put something on the shelf and when we receive the cash for the sale. So there's the amount of time it stays on the shelf, and then there's the amount of time we're waiting for the customer to pay. And when we come back next time, we will discuss the AP period. So what I want you to do for next time, I want you to read the rest of Chapter 18 if you haven't, and then we will start credit and credit policy. Remember, we have readings, PDFs that you need to go read before class next time. Are there any questions? Okay, I will see you next time.